Right, welcome to this cost of living and financial resilience brief from Serve and Protect Credit Union. Not many people realise that Serve and Protect is actually a free employee benefit that's available to yourselves within your employment. We help you save. We're also there if ever you need to borrow money throughout your career and beyond. So that's me, I'm Rob Lovesey. I do a lot of these sessions, wellbeing events, whether in person or online. And it's just really important for me to just mention that today I'm going to talk about some of the financial trends and cost of living challenges that our members face, but I'm not a financial advisor, so I can't give specific advice. Just bear that in mind throughout the presentation. As I say, I'm going to speak about a lot of the trends and hopefully some signposting options that are available to yourself. As mentioned, we're a free employee benefit. We were actually founded in 2003 after a merger of different constabulary police credit unions. We now serve 43,000 members, 36 police forces across the UK who offer our service as a free employee benefit to help colleagues save, but also borrow money with repayments straight from their salary. In 2012, we extended the service to help His Majesty's Prison Probation Service. In 2015, the Ministry of Defence, and more recently, in the COVID-19 lockdown pandemic, we extended the service to fire and rescue services and also health services. You can see there, this is our mobile app, and we currently serve over 43,000 members. We're really proud to look after £80 million worth of your savings, and we have approximately £70 million out on loan to help our members. But what makes us different? Why is a credit union different to a bank or building society? After all, we offer the similar kind of products. We help people save. We're there if they need to borrow. One of the key benefits at the top there, you can see we're exclusive. So only certain people can join a credit union. In our case, it's based on who you work for. So if you're employed by any of those sectors that I mentioned previously, you're entitled to join the credit union and start saving with us. Once you join, any family members that live at your address are also welcome to join. The only difference is that they save via direct debit. Now they have to live, your family members have to live at the same household as you, an existing member, and it can only be available to immediate family members such as parents, spouses, partners, or children. We are a cooperative, so this means that we're owned and run by you, our members. We don't have private shareholders that have investments in the credit union. Everything we do is just to benefit you, our membership. And a key difference there at the bottom, we are not for profit. So we do have to make a profit to be sustainable, but what it means is at the end of our financial year, based on the profits we make as an organisation, we pay those back to you, our members, in the form of an annual return on your savings. So you may get an annual dividend, for example. We also invest some of our remaining surplus profit back into the running of the business to improve our products and services that are available to you, our members. So today's session is looking at how you can improve your financial resilience and general cost of living support. At the credit union, our mission is that we're passionate about improving the financial resilience of you as individuals. We know that if we can help you look after your money better, then you can actually just be better focused on the job in hand. Why is it important? You can see here, financial worries make up just one aspect of a wider holistic approach in terms of your well-being and your welfare. Whether it's relationships at work, relationships at home, mental health, attendance or productivity, we know that finances can impact all of these aspects of your life. So again, if we can help you manage your finances better, then the knock-on effect is going to help these areas across your life as a whole. But first of all, let's look at what financial resilience is. So financial resilience is the ability for you as an individual to withstand financially stressful events that impact your finances or your assets throughout your life or your career. So let's take, for example, your car breaks down and you need to find £600 overnight to be able to pay for the costs of those repairs. We want to make sure you're ready financially so you have enough money saved to be able to respond. And as we live in a cost of living crisis, we know it becomes more difficult for people to save. So we also want to know that you know what options are available for you to get emergency support if you need it. You'll hear a lot of work about financial well-being. That is essentially your short-term relationship with money. So have you got enough money at the end of the month to be able to afford, take the other half out for dinner, the occasional takeaway? We're finding that our members actually have quite good short-term financial well-being, but they've actually got quite poor long-term financial resilience. So building that savings pot in an easy access savings account to be able to respond to any financial emergencies that may arise. Obviously, we know in the police family and a lot of the markets we serve that you have regular pensions that you're paying into. That's obviously a long-term financial package that's available to you after a certain period of time, which you can't necessarily dip into. So again, it's important for you to think about easy access savings, having money you can access whenever you need in that emergency. Here are just 3 examples of things that can happen and typically happen to our members when they come to us for support. At the moment, life may be great. You're not experiencing these things throughout your life or your career, but from no fault of your own, any of these things may happen to you, and you need to be able to respond financially. We see a lot of members, for example, let's use the COVID-19 pandemic, when our members were actually working and probably earning more money than they've ever had before. But why did the phone go to the credit union? Why were people seeking help? It was because their other halves had either been furloughed or lost their jobs or experienced health difficulties. So again, start to think about your reliance on that dual income. If you do have a dual income at home and you've got a partner that contributes towards your bills, think about how resilient you would be if it was just you. Are you able to respond? These are the questions you need to be thinking about and starting to prepare for the future. We also know, due to the nature of the markets we serve, the irregular shift patterns, high stress environments, that the stats show that there's quite a lot of relationship breakdowns. Some of our most loyal members have been really financially resilient. They've been in secure relationships, dual incomes coming into the household, and then overnight something happens, that relationship breaks down, and they're on their own. And some of the lenders that would have helped them previously maybe won't lend to them because they're not, as an attractive risk profile as they previously were. So they've struggled to get the support they need, but the credit union can be there for those people. These are just 3 examples to think about that, life might be great now, but you never know what's around the corner. You need to prepare for the future. So ask yourself the question, how ready are you financially? Should your car break down, that example that I used, have you got enough money to be able to dip into an easy access savings account and pay for those costs? We're finding that a lot of our members and employees that we speak to are really struggling. So you may need to know what options are available. There's also some stats here. I do a lot of work about in-work poverty. And this is essentially people that are in paid employment that are actually being missed in society. So they're earning money to get by, but they're struggling because they don't qualify for benefits. They're not the highest earners, and they're just struggling every day to meet their financial commitments and their day-to-day bills. So in-work poverty is when a person's income, after housing costs such as mortgage or rent, is actually less than 60% of the national average. And they don't earn enough to meet the cost of living costs. So essentially they're living in poverty. And you can see here, the national average is about £33,000. That's the average salary, which does seem quite high actually. But you can see the minimum required to be taking home after you've made your payments towards your mortgage or your rent. It's actually looking about the 19,000 mark, just over. So actually a lot of employees we speak to are falling into that in-work poverty trap. Before the cost of living crisis, 1 in 8 of our colleagues were experiencing work poverty. Now, no doubt with the cost of living challenges, I'm going to touch upon some of them throughout the presentation, that number is just going to increase or has increased already. And who's the most vulnerable? These are some of the categories that really suffer this in-work poverty, whether it's families without full-time workers, families with disabled people, people that are renting, single-parent families, families with 3 or more children, or households headed by someone non-white ethnicity. These are the sort of groups that can be the most vulnerable to the in-work poverty cohort that we're talking about. And what's more, there's something called a poverty premium. So those people that are most vulnerable in society, that are really struggling, are actually having to pay more across certain products and services because of the risk, the profile that they find themselves in. For example, if you think about, we talk about insurance products, I've done a list there of different things where you get charged more. Because, for example, if they say, this is your cost of your insurance, if you're to pay it off in a lump sum, it's going to cost you X amount. If people haven't got those lump sums to be able to afford those costs, they then get the option of spreading that across the whole year, but it's actually at a cost. It pays more. So people that struggle to pay for those costs, such as whether it's prepayment meters for gas and electric, different bills, household insurance, prepaid cards, or even interest on loans or credit cards, those people that are deemed the higher risk, that struggle maybe to make those repayments, can be charged more. So this is just a cycle of how in-work poverty can affect and actually cost people more than they actually realise. So ask yourself the question, right? We said, if your car breaks down, have you got enough money to afford those repairs? Ideally, as a credit union, we want everyone to have a savings pot that they can just withdraw from and respond. In an ideal world, that's what we want to work towards, and that's what we strive for. Obviously, we appreciate the cost of living crisis. People are really finding it hard to find disposable cash to save. Some of us are not lucky enough to have friends or family to turn to in an emergency. Some of you will, which is great. Others won't. So, throughout your life and your career, there may be times where you're going to need to borrow money. These might be emergencies that arise, or they might be aspirational things that you're looking to, whether it's a new car you're looking to purchase. There are times you may need to borrow. It's really important that you just know what options are available. And there's something at the moment called iceberg loans. It's probably worth noting and being aware of. When you see the TV adverts from banks or building societies that offer headline rates, most recently it's been as little as 3%, but interest rates are increasing. They only need to offer that headline rate to 51% of customers to be able to offer that rate and then do a marketing campaign around it. So actually the rest usually pay more, or they don't get the support they're looking for in the first place. So as a credit union, we're really passionate about making sure that that 49% that maybe don't qualify for those headline rates know that they've got options to turn to if they need support. If they don't know a credit union exists, where are they turning? We're finding a lot of our members and your colleagues turning to high interest creditors such as payday loans or credit card companies where APRs can exceed 100%. It's a really expensive way to borrow money, but because people don't know what options are available, they're turning to these providers. Now on the screen here, you can see a payday lender, typical payday lender on the right hand side. If you needed £1,000, again, the example of your car breaking down, you may go to your typical payday lender and they might charge you £148 a month. People tend to look at that and think, I can afford the £148. What they're not looking at is how much they're being charged to borrow that original money. So in this case, to borrow £1,000, they're charging you £782 just to borrow the original 1,000. That's the cost of that credit. So £782 on top of the 1,000 at an APR of 341% APR. People are using these providers. When there's credit union like ourselves out there to support you, you can borrow monthly repayment £89, total interest £74, and the APR 13.5. Again, some people say to me, oh Rob, the APR is quite high. It may be, if you've got a great credit profile, if you're a homeowner, you may be able to qualify for those headline rates that banks and building societies offer. But we're finding that a lot more of society are not having that support available to them, and they're actually having to borrow at far greater rates. So be aware of the credit union as an option that you may want to turn to. You shouldn't have to be going down to the route of these payday lenders, no matter how tough times get. Because when you add it up, payday lenders sometimes charge a fee, but to borrow that original £1,000, you're having to pay back over £1,800 with this payday lender, whereas with a credit union, £1,074. So it's a minimal amount compared to the payday lender. So it's just education awareness, letting people know that the credit union is out there to support you if you need it. And throughout your career, just recognise the dangers of a payday lender. Not a lot of people realise that if you take a payday loan out, even if you pay it off the following week, it still shows on your credit profile for 6 years. You may save for a mortgage or want to borrow money for other purposes. Some lenders may not lend to you, or if they do, they might charge you a higher rate because you're deemed a higher risk. So how can you build your financial resilience? Okay, we want you to have money saved so you can respond, but we also want you to make sure you look after your credit profile. So if you need to borrow money in an emergency, you get access to the best rates and more options that are available to you. Here are some simple steps that are shared by our members. Typically, I ask people in the room, how many of you have done a budget? Very few hands go up. A lot of people that come to me that really struggle to save have never actually done a budget. Now, as simple as it sounds, a lot of people, they're not confident with maths or Excel. So we've actually developed our own budget plan online. You can go onto our website and search our budget planning tool. You can put your details in. You can then establish how much money you have coming in, how much you have going out, and then working out, if you're spending too much, what areas those are. You can break down and categorize your spending. That's a really good place to start to take control and ownership of your financial behavior. There are lots of different budgeting methods, and we do a different presentation specifically on budgeting, so I'm not going to go into them in great detail now. But there's the old school envelope system. So, back in the day, parents may have saved like this, where they had an envelope specifically with money for their car insurance or saving for holiday or a Christmas, and they literally physically had an envelope where they put money in, and that was their budget that was set aside for that expenditure item. Now, banking apps or mobile apps are quite sophisticated, so they have their own online envelope systems. So you can save side pots of money for different items. It's a really good way of starting to save. Zero-based budgeting is where you look at how much money you're taking home, and then you want to make sure that every pound goes as far as it possibly can. So whether you're allocating money for different items such as your mortgage, your rent, different utilities, shopping costs, etc., you're then left over with an amount, and that money goes straight into a savings pot. So you're utilising those funds as best you can. You've got the 50-30-20 rule, which the Money Advice and Pension Scheme recommends. That comes from the government. Essentially, that 20 stands for 20% of your income they want civilians to save. That's the goal, 20%. But we know people struggle. People are struggling to save a minimum of £10 with the credit union. That's the requirement. People struggle. So what I'd say to you is don't focus necessarily on the percentage amount. The hardest thing about budgeting and starting to save is just getting started. If you're someone that really struggles, you'll always put it off for another day, never get round to it. So the sooner you start, the better. Even if you save a small amount, it soon builds up. It can become quite rewarding. You can then top that up as you progress throughout your career, earn more money. You might get a bonus, you might get a pay rise, and you can start to build up that savings pot. There's also the pay yourself first approach. So as soon as you get paid, that money goes out. So after you've itemised all your key expenditure, money goes out straight away into a savings pot so you don't miss it. So it's not in your account ready to spend. Some people like to set a savings goal, and they find it a really easy way to save when they've got something aspirational to save towards. What I say to people when I do these sessions is, do they actually know how much things are costing? Have they thought about what they aspire for in life and how much these things will cost? Because it might be quite fascinating. You can see here some of the everyday purchases that people might aspire to save for throughout their life or their career. Whether it's a new car, we talked about it. If your car breaks down, you need to buy a new car. A lot of our members need a reliable car to get to and from work. The average cost of a small hatchback came in at £12,000. A lot of people you'll see probably have a lot bigger or faster cars than a small hatchback. They might be borrowing that money on PCP, hire purchase. These are different ways you can finance these cars. But the message is, it takes a long time to get to that 20,000. So the sooner you start saving, the better. Again, holiday, average spend per holiday, £855. So again, you look at £100 a month, saving for a year, that'll pay for your holiday, just for one person, and some spending money. That's just from £100 a month. This one gets a lot of people depressed when I share this one. This is based on what is the average deposit being put down by first-time buyers in the last year. On average, this covers the whole country, so don't be alarmed. But it's £53,935. That's the average amount first-time buyers are putting down. And then typically, owning a house might not be for everyone. You might just want to rent. That's absolutely fine. But some people might then decide, I want to start a family. I want to get married. Average cost of a wedding, 20,000. I've got 2 young children, so every time I see this stat, it scares me a little bit. Average cost of bringing up a child to the age of 18, £160,000. And then, you have your Christmases. Average spend at Christmas, not just on presents, but the whole of December, going out with friendship groups, work colleagues, etc. You're looking at about 1,100. Why do I put those figures in? It's just so people can realistically look at, wow, this is how much things are costing at the moment. And if I want these things in life, we want you to start saving towards them. It's going to take time. You're not going to be able to save up for everything. Mortgage, for example, is a cost of borrowing. However, you've got to start that savings journey somewhere. So the sooner you start it and you take ownership, the better, even if it's a smaller amount. Because saving that £100 a month, whether you're putting £100 aside just for Christmas or holiday, it's going to take you 5 years to save £7,200. That's from £100 a month. So you haven't even in 5 years saved up for that small hatchback car that you're looking to buy. So again, I don't want it to be too depressing. It's just more being realistic. The fact that that's £100. So there are ways you can find money to save, to put towards a savings account sooner rather than later, the better, because it builds up. It will take time. What else can you do to improve your financial resilience? So I talked about it when there's going to be times that new car, if you haven't saved the money, you may need to borrow money, whether it's a car, whether it's a mortgage, whether it's for any of those costs that I listed. We want to make sure you're in a really good financial position so you get access to the best rates around and you get more options. Because what we're finding, people that don't look after their credit profile or haven't checked their credit score, they might have some surprises on their credit profile. And when they come to borrow, that's why they're probably being charged higher rates or they're being told no by certain providers. So go away, think about checking your credit profile. You can do it for free, so it's free of charge. Here are free sites. Credit Karma I use, but you can go on them. They will ask you for your bank or building society number. And you'll say, well, that's strange. I saw the webinar from Rob and he said they won't charge. All they're doing is asking you to validate some personal information about your expenditure. They may say, how much did you spend at Sainsbury's on Sunday? Once you answer that question, it unlocks your credit profile. It gives you a score and it'll give you loads of hints and tips and an overview of how much money you borrow, whether you're keeping up to date for repayments. Credit Karma gives me an email report every month. It shows me, it gives me tips to improve my score. It tells me if people have applied for credit or if I've applied for credit. So it's a good fraud prevention tool as well. So think about checking your credit profile. These are the things they take into account. Payment history, so amount owed on credit, so it's called indebtedness, the total amount of debt that you carry, the length of your credit history, whether you've applied for new or recent credit, and also types of credit there. So you can see 35%, your credit profile's impacted by your payment history. So it's pivotal, make those repayments where you can. A lot of members I speak to have moved property, they moved because of work. They might have a mobile phone bill that they've just forgotten about and they haven't made the repayment. That could be dragging down their credit profile as a missed repayment. It's really important you go onto your credit profile to check these things, to take back control and get that ownership of your finances. So cost of living concerns. The second part of this presentation is just to cover off some little hints and tips around cost of living. We know saving's difficult. These are ways you may be able to save money. You're not alone. No matter what you're earning, where you are in the world, I'm sure everyone's feeling this cost of living crisis. We survey our members and 50% are actually very concerned with the continual increases in cost of living and the overall impact on their personal finances. We then wanted to share some insight into little things that can be done to try and help people save and try and reassure them about some of these different increases in the cost of living. Energy bills. It's by far the most concerning item to our members. 84% were extremely concerned about the increasing energy costs in the next 12 months. Bear in mind that these stats were done middle of 2022, so obviously things have changed in the energy space, but it's still a concern for a lot of people. So what can you do to reduce your energy bills if you are concerned? There are these little hints and tips that people talk about. But the idea is if you do them collectively, you can actually make some big savings. So draft proofing your house. As trivial as it seems, where you've got cracks or you've got drafts coming in and you can feel that breeze, it's going to be costing you money because you're going to have to increase the amount you spend in terms of energy to heat your house. Draft proof the windows, doors, block the cracks, put an old towel down, by the doorway, those sort of things, old curtains. They can actually save you up to £125 every year. So again, if you're someone that said, I can't afford to save, I can't even find the £10 to save money, potentially draft proofing your house could save you that money. Thermostat, so turning your thermostat down by 1 degree can save you £105 a year. Just turn it down 1 degree. Standby mode on appliances, so turning standby mode off can save you £65 a year. Fitting an aerator, a lot of people ask me what's an aerator. Essentially it's something you can put at the end of your shower or your tap, and it uses the same amount of water, well, it reduces the amount of water you're spending, but keeps the same pressure that comes out from the tap. And you can sometimes get these from your local energy firm if you contact them, depending on where you work. That can save £30 a year. Swapping a bath for a shower once a week can save you £20 a year. I don't want to sound like Boris Johnson talking about kettles, but avoiding overfilling your kettle and only using it when you need it, £13 a year. Now I appreciate some of these savings, they don't seem a lot, but when you add up all of these 6 things and doing them as a collective, you can see there, you're probably saving over £350 every year. So if you're someone that struggles to save, that can't find the money to save, little things like this may free up some disposable funds for you to start that savings journey. Cost of fuel. Again, this has started to go down recently, but nearly 1 in 2 of our members, 48%, were concerned about the cost of fuel and the rising costs. You can see here, it wasn't so long ago, now unleaded cost over £2 per litre, diesel was exceeding that. Obviously it has gone down, but you can see the trend. So December 2020, it was £1.14 pence per litre. It peaked, in December about £1.52 per litre. That was December 2022. It has gone down now. But again, a lot of people still say the cost of fuel, we look at recruits. Some of them are struggling to pay for fuel to get to and from work, and they're having to borrow that money on credit or turn into a payday lender. What they can do is, a lot of people don't realise, by driving at 60 miles an hour rather than 70 on the motorway, for example, you burn 9% less fuel. So actually that's a way of saving money. Just from looking at your behaviours and your driving behaviours, you can actually make some savings there. Driving at 80 miles an hour, no one listening to this webinar should be driving at 80 miles an hour. But if you do and you find yourself creeping over that limit, you burn about 25% more fuel than driving at 70 miles an hour. So even behaviours such as driving can be ways of saving some money. Paying for food every day or every week, you'll do your grocery shopping and you'll see the prices just creeping up constantly. 23% of our members were concerned about actually just paying for food, the cost of feeding their family. Grocery inflation is recorded to hit an all-time high. The average grocery bill set to rise by about nearly £800, so £788. It's a staggering amount. So people need to find that money just to be able to afford their annual grocery shop. This is something Martin Lewis recommends. It's called the Downshift Challenge. And I ask anyone, next time you go shopping, think about this. You may be able to make some savings. What does it mean? It challenges you to drop a brand level when shopping for your groceries. So imagine if you buy a premium brand, whether it's ketchup, mayonnaise, what have you. If you're used to buying a certain brand, you will see that there are other brand levels, whether it's premium, branded, own brand or value, that are much cheaper, and actually they probably don't taste much different, but people are falling into the habits of spending money on these premium brands because, what do you know? They market at eye level. They're very good at marketing to you. So when you're in a supermarket, you'll see the premium brands in front of you and people naturally just buy them. A tip that someone told me was just crouch down a little bit when you're shopping, when you're looking at items, and you'll see the value stuff down right at the bottom. So if you try and drop down a brand, ask yourself the question, what ketchup are you, for example? Do you always buy Heinz? Could you drop down to some of these other brand levels? You can make some big savings over time and test it with your family, see if they actually notice. Many people may not. Stick to that brand then if they don't notice. Because what's it mean for you financially? This is the so what. A typical family of 4 spend on average about £108 a week on their shop. By doing this downshift challenge, it can reduce your bills by up to 30% every single week just on these groceries, this grocery shopping. So it's bringing your spend from £108 down to £75 per week. So you look at the savings there, £33. You spread that across the whole year. You can imagine how quickly that adds up as a big saving. So again, the message from today, if you struggle to save and you're struggling to find money to save, this is just one thing you may be able to do to change your behaviours to try and free up some disposable cash to save. Mortgage and rent, 15% when they answered this survey back in 2022 were really concerned about their mortgage and rent. I imagine that figure and that percentage has gone up substantially. There's an interest rate rise potentially next month, which, interest rate at the moment, base rate's 4.5%, could go up even higher. They're forecasting that in the years to come, we're probably going to be looking at about headlining 6% on interest in a world where people have been borrowing on their mortgage at rates, below 2%. It's going to be a real shock for a lot of families. You can see here, this is some forecasting we did back in May 2022. You can see how the base rate of England base rate was rising. It was forecasted in July to be at 4.6%. So obviously today, we're in June 2023. It's actually at 4.5, so it's probably going to jump even higher than that 4.6, which is forecasted. So if you're struggling about repaying your mortgage, just make sure to ask yourself these questions. Do you know if your mortgage is on a fixed or variable rate? Now, it sounds quite straightforward, but a lot of people I speak to just head in the sand. They just don't know what kind of deal they're on. If you're fixed rate's typically cheaper. Again, I'm not a financial advisor. I'm not going to tell you what to do, but look at the fixed rates. If you're confident and you might be reassured to know this is how much I'm going to pay for a set period of time, that might work for you. Variable rates can change depending on the Bank of England base rate, and some people like that. But what we find is sometimes it becomes more expensive when you switch onto that variable rate. So just make sure you understand your own mortgage product you're on. If you're on a fixed rate, when does it come to an end? Some mortgage providers, you can actually lock into a new deal before your existing one expires. Sometimes it can be up to 6 months beforehand. So don't be afraid to pick up the phone, engage with your lender, your mortgage provider, to see what deals are available to you. And also, have you budgeted? Again, going back to budgeting, have you looked at how much it's going to impact me if the interest rate continues to rise and my mortgage is renewed at a certain rate? How much more is it going to cost me and where I'm going to find that money from? Because what's the impact? £300,000 mortgage over 25 years. If you're used to paying an interest rate of about 2%, your monthly repayment's about £1,200, £1,272. This is just based on this £300,000 mortgage calculation over 25 years. An interest rate rise up to about 4% sees your repayment go up to nearly £1,600, so rising about £311. Up to 6%, you can see how that impacts you by 661%, that increase. This is a big jump for a lot of people. And where are you going to find that kind of money from? You need to forecast, you need to budget, you need to consider your options, what are available. What if you can't afford it? Again, try and build up your credit score. By taking steps, building up your credit score and your profile, you're going to be a better risk profile to lend to from mortgage providers. So you're going to get more options to consider and they're going to offer you the better rates that are on the market. But try and take steps to build your credit scores. A lot of them will give you hints and tips on how to do that. So try and engage, try and learn more about that from checking your credit profile. You may want to switch deals, shop around. A lot of people just get used to banking with certain providers. Their mortgage comes to an end, they just click a button, renew it. There might be cheaper rates on the market, but shop around. There's all these money-saving sort of websites out there that you can research, but do your research, have a look. Also, if you're in a position where you've got disposable money, you may want to consider overpaying on your mortgage, making additional payments. Just be aware though, there are certain limits on some products in terms of how much you can overpay. Because if you pay too much, sometimes they charge you fees. So just be aware of that. But again, do your research, check your deal. But these are little tips you can do if you think you might not be able to afford the interest rate rises. Repaying loans, again, 17% of our members were concerned. One thing that our members are doing to actually save some money, so if you've already got debt, such as payday loans or credit cards or personal loans, overdrafts, a lot of people actually do something called debt consolidation. Now, I didn't realise till I did more of these sessions that people weren't actually familiar with what debt consolidation is. What it means is if you've got multiple debts, and the example here is 2 credit cards and a store card, all with £1,000 outstanding on the credit, some of them 20% APR, 25%, 30% APR. So you can see that debt totals £3,000, averages about 25% APR. So what you can actually do is look at taking out a loan from whether it's a credit union or another provider to see if you can pay off those debts and borrow £3,000 and see if they offer you a cheaper rate. If they do offer you a cheaper APR, the likelihood is, but check the small print, check the total cost of the credit, the fact that you may be able to save money on those monthly repayments. So again, even if you've got existing debt, you may want to shop around to see if you can save money on the rates. Because the average credit card interest rate there is 26.7%. So again, go back to the example, credit union, payday loan. You borrowed £1,000 with us, 13.5% APR is what we'd charge you for that. So again, if you've got credit cards at these kind of rates, you may be able to make savings. Different tips for support. Again, we talked about changing providers. It's not just your mortgage provider. If you've got broadband or mobile phone contracts, think about switching. You may have better deals out there. You may be able to make savings. There's the household support fund, so speak to your local council. There might be support that's available to you that you don't know exists. Engage with them. They've got funding to be able to support. The Trussell Trust is a network of food banks that provide emergency food and support for people in crisis. If you do find yourself struggling with those costs, with grocery inflation, and you're struggling to feed your family, it's imperative, Trussell Trust, reach out to them. We're seeing more people contact the credit union. They're literally struggling to find the money to feed themselves and their families, and it just shouldn't be the case. So please do reach out to the Trussell Trust. There's water savings gadgets. I talked about the aerators. Go onto sites like Save Water, Save Money, and depending on your postcode where you live, you may get some of these for free, but do shop around. Tax relief, there might be loads of benefits that you qualify for that you don't even realise. A lot of people we speak to in the markets we serve are very proud people. They do a great job for society. And sometimes they think, well, actually, I'm not going to claim benefits because I'm in paid employment. That's for other people that are more deserving. No, if you qualify for these benefits, you need to claim these. You can see here the stats, £16 billion worth was unclaimed in benefits across 8 million households in the UK. That may be you. You may qualify. So what have we done to make it super simple? There's a tool on our website. This is free for anyone to use. We don't ask for any specific personal information. It's just your general circumstances. You can put that into our calculator and it will tell you what support is available to you or what's not available. So either way, you can just find out. You might actually save yourself some money in that respect. We haven't got time to go into these today, but these are other things just to think about your behaviour with money to make sure if you need support, you're in the best position possible to get that support. Problem gambling. We see a lot of people that gamble regularly. Whether it's social or problem gambling, there's no fixed definition. However, just be aware that if you gamble regularly and then you apply for credit, you may not get the support you need, or you might be limiting your options. And some of the people that will lend to you may be the ones that charge you a higher rate. So at the credit union, we're a responsible lender. So if we see patterns of behaviour, we can't responsibly lend to people if we see problem gambling creeping in. Buy now, pay later schemes. You're probably familiar with a site called Klarna. You'll see it cropping up online regularly. It's a buy now, pay later firm. You can purchase items. They've just done a deal with Just Eat Takeaway, believe it or not. So you can buy takeaway and buy now, pay later. We're finding a lot of recruits, for example, that are moving for work, unfurnished properties. They're furnishing their property, new bed, sofa, TV on these buy now, pay later schemes. 0% APR, spreading the cost of that repayment over a certain period. All it takes is for one missed repayment and then the interest rate gets hiked up and it can get you into a lot of financial difficulty. The term related to buy now, pay later is just think about not becoming too over-committed on these schemes. By having too many of them, one thing changes, not being able to afford them can really get you into a spiral of debt, and it can become unmanageable for some people. And then you see people falling into the payday loan, the high interest credit trap. We've shown the example. High interest credit is APRs of over 100%. Just be aware that with a credit union as an employee benefit that's available to you, there's no reason you should be turning to these payday lenders if you manage your money right and when you've got a credit union available to yourself. We can't help everyone, but we try and help people where we can. Our message is very much, we're here to help our members save. We want you to save money, but we're there as an option if you need to borrow. You just need to know the credit union's there as an option. You can see here the benefits available, payroll deduction. So your force may have allowed your colleagues to save and borrow with the repayments straight from their pay. There's no hidden fees, so it's completely free to join and start saving. You have to save a minimum of £10 a month. You can withdraw that money whenever you wish. If you have a loan, you can repay it without penalties. And if you want, you can close the account whenever you wish. You're not tied down. We also offer free life cover, which gives you a bit of peace of mind, added peace of mind. So should the worst happen to you and you were to pass away up to the age of 65, we double the first £25,000 you have saved and give it to your next of kin. Same with any loan, we'll clear your loan. There are terms and conditions, pre-existing medical conditions, etc. But in general, that's a really good benefit that's available to people. Safe and secure, so we're fully regulated by the FCA and the PRA, so the Old Bank of England, and your savings are protected up to £85,000, just like a bank or building society, by the Financial Services Compensation Scheme. And what's more, our team are on hand Monday to Friday, 9 till 4:30. So if you need any support, just pick up the phone. Most people in financial difficulty have a story. Let our team know. We'll do our best to try and help you where we can. There's our app, Serve and Protect. And if you want to kickstart your savings today, feel free just to download the app and use the promo code WMP10, and that will give you a free £10 just to start your saving. Thank you.